Welcome back, everyone, to Lenders Online Training. It's our live stream, or maybe I should say it's a podcast, because we do like to converse on some of these topics. This is where we focus on practical, real-world credit insights for our today's lenders. I'm Dave Stoffaker. Many of you know me. I'm the Senior Credit Trainer with Lenders Online Training. Today, we're going to be tackling a topic that shows up in every commercial real estate deal. But I would say that it doesn't always get the attention that it deserves. It's cap rates. What are they? Why do they even matter? And what impact do they do with the credit decisions that we make? So on the surface, cap rates look like a simple math equation. But in reality, I think they quietly drive valuation. They can influence our loan structure. And in most cases, they sometimes mask risks that we don't pay attention to. Now, to walk us through this, I'm joined with my colleague, my fellow senior credit trainer and friend, Joe Davis. Welcome, Joe.
Thanks, David. Great to be here. And you're exactly right. Cap rates or capitalization rates are simple on the surface until you really dig in and you realize how much is riding on just that one number.
Yeah, you're right. So right, Joe. And like I mentioned before, this can be a confusing topic. So I want to start out with, why do cap rates even matter? Why should we even care as a lender? Now, it's easy to say that cap rates are one of the primary drivers of commercial real estate valuation. If the rates are too low, you might be overvaluing the property that you're looking at. If they're too high, the deal might not even support the financing. Either way, all this impacts our credit decision, right?
Yeah, absolutely. And I always think of cap rates this way. Cap rates are the bridge between cash flow and value. They're kind of the vehicle that translates cash flow into value. If that bridge is off, everything on top of it, built on top of it, is off too. So that's the valuation and ultimately the lender's collateral position as well.
I love that. That is simple. All right, let's keep on the simple topic. How about the math? The math perspective, it's kind of basic, right? It's simple. Once you know it, you take cap rate is basically the net operating income of the property divided by its value. Or if we want to flip it over, want to do some magic to it, it's the net operating income. It's divided by the cap rate, gives you the value. Pretty simple stuff, right? So, for example, I'll try to make this easy for mathematicians, because I'm a simple person when it comes to math. Let's say a property generates, let's say $100,000 of net operating income. Net operating income, that's kind of the key when we're thinking about that. So if I used a 10% cap rate, do the simple math, the property is worth about $1 million. Now, if that rate went down, and did the same calculation, net operating income divided by the cap rate, my property goes up. Goes up to like $1.1 million. It's like $100,000 change in just 1 percentage point. Well, that's a huge impact, right, Joe?
Yeah, and that's really the part that lenders tend to underestimate. We dig deep into debt service coverage ratio and really crunch all of those numbers. We do stress testing, we analyze multiple scenarios, and we absolutely should. Not criticizing that, but we just often accept the cap rate without much challenge or critical thinking. We just kind of blindly pick up the appraisal that says this, we call it good. So there's no stress testing, no questions asked of the appraiser, no comparisons to similar deals in the portfolio. Those small changes have a really big valuation impact for sure.
So true. Let's kind of recall a few years ago, COVID hit us, right? Think back to the early 2020s. Some of you recall that. We all lived about that, right? It's right before COVID basically came upon us. We were seeing cap rates at the time, probably for retail, some office was maybe in the 6% range, 7% range. Deals were getting done. The valuations were holding their own. And, lenders felt comfortable in lending on commercial real estate. Well, fast forward a few months, we get into 2020, things changed significantly, didn't they, Joe?
Yes. So you could have same buildings, and just a completely different environment in the world, values change. And they did very, very quickly. It's an extreme example, but it happened.
Exactly. The income didn't necessarily collapse at that moment overnight, but the perception of risk did. Remember, many of us didn't have to go to the office for an extended period of time. So the risk inherent in that situation was the tenant situation was uncertain. So collections were somewhat, questionable at the time because we didn't know if the tenants were going to go back. Vacancies started to go up, so that kind of impacted the cash flow opportunities, but the risk was higher, right? Investors became a little bit unnerved and they wanted higher returns for the risk, right? We put the return and risk together in the same equation.
Yeah. So absolutely, which means higher cap rates, right?
So when you think about that, I think we use this often to say the punchline. If we have the same deal and I have a cap rate at 6%, or if we go through our sensitivity analysis and try to stress it, suddenly that property looks different at a 7% cap rate. If it went to 8%, it's even more different, even if the net operating income doesn't change, right?
Yeah, absolutely. That's the cap rate shock that we're talking about. It's not because the math changed, it's not because the cash flow changed at that point, but it's because the risk got repriced. Investors or buyers, let's call them, they demanded a higher return on the property. And appraisers certainly took note of that and they followed suit.
So when that happens, when there's changes in the marketplace, perceived risk, the appraisers kind of get a feel for that, what's going on. Our collateral position can change very quickly. I think sometimes that, if I recall that maybe our collateral position has changed, there's risk in the environment, but we're over here focusing on the debt service coverage, how the rent's coming in. We focus on that and forget about, sometimes this happens, we forget about what happens to our value of our real estate on the appraisal that we would have accepted 5-10 years ago, and we had a number there. It's like, well, wait a minute, is our value still what it was? We sometimes fail to recognize that. Make sense?
Yeah, and that's a bad spot to be in when your secondary source of repayment turns into your primary source of repayment. In other words, when you're talking about foreclosure liquidation.
Oh gosh.
Yeah. But let's talk about what actually drives cap rates a little bit more. We touched on this, but at the core, cap rates reflect that required return. Investors are asking, what return do I need for this level of risk? Where else could I put my money, and at what rate of return could I get on that? Kind of treasuries is the benchmark. But they need proper incentive and return to invest in a certain property, and that's what's going to drive those cap rates, translating the cash flow into the value.
So if I can reflect upon that, ties directly to interest rates, because investors probably compare that they can invest into treasuries. But if they go into real estate, they might assume that there's more risk. I'd want a higher rate of return, right?
Yeah. Yeah.
Now,
I'm sorry. Go ahead.
Okay.
Please.
Is with that thought in mind, is there different cap rates for different types of properties? Because in commercial real estate, there's several types of commercial real estate, right?
Oh, yeah. Really good point, David. And we all know the first 3 rules of real estate, right? Location, location, location. So location drives them. But also, to your point, property type. So the cap rate on an office building right now is going to be vastly different from, say, a fully occupied medical facility. Office space is deemed to be very high risk, and fully occupied medical facility probably fairly low risk. So those two things going to have very, very different cap rates. It's not just the cap rate is the same in each market. So that's a really good point. There are a lot of different drivers of this. Appraisers spend a lot of time determining and developing their cap rates, and you should absolutely review that when you're looking at appraisals for sure. And that's, go ahead, please, David.
And that's interesting. This is me being a little bit humble and naive back in the day. When I was thinking of interest rates being volatile, moving up, moving down, I at times failed to recognize that that type of movement in the marketplace of what we as bankers would charge to our clients to borrow money, that sometimes that rate didn't necessarily have a direct correlation to what a cap rate was. Maybe somewhat of an indirect one, but they didn't necessarily move at the same times, let alone those cap rates are different between different properties that we were doing. So now it makes it all spinning in my head, right?
Yeah, cap rates absolutely do move with the markets. It's not always immediate. Interest rates, I always think about interest rates as kind of pulling cap rates along kind of slowly behind them. There's a little bit of a lag. So they don't move immediately, but they do move. And this is the way that interest rates drive economic growth or economic contraction. This is why the Fed spends so much time discussing and adjusting interest rates, because they're manipulating the market to counteract economic recession, or on the flip side, inflation, which is certainly on all of our minds right now.
Let's tie back to tenant risk. We did a podcast with regards to owner occupied real estate, non owner occupied real estate. So it kind of ties back to there that you can have two properties that look identical. The net operating income could be pretty much the same, maybe a similar location, but different tenant structures. How do we deal with that?
Yeah, that's a really good point. Investors and lenders won't price those two things the same, because ultimately the tenant is the real paymaster. That's going to be a recurring theme with our CRE series. They're ultimately responsible to repay your loan indirectly via rent payments.
So if I have a very strong tenant, now granted, sometimes we have to understand who that tenant is, right? That's one of the key questions. If it's a stronger tenant in our eyes, that would be perceived to be lower risk, lower cap rate, higher value. And the flip side, right? If it's a weaker tenant or a weaker tenant structure, higher cap rate, because there's more perceived risk, and a lower value of the property, right?
Yeah, absolutely. That's how that works. You're pricing for risk. Cap rates absolutely reflect the risk. Strong tenant, strong lease agreement, nice market, very low cap rate. Any of those things is less strong, you're going to have a higher cap rate.
Okay. So we've given our lenders or analysts a lot to think about. But where would lenders potentially get into trouble? I'd like to touch on that. Where could they get in trouble?
Yeah, they can really focus heavily on cash flow, as we talked about. They don't question the assumptions behind the values. That's when you're essentially outsourcing your underwriting. As we've said before, you can't do that. Don't outsource your underwriting to anyone, including appraisers. You still need that critical thinking. You need your loan policy. You need your policies and procedures to stand behind, because they're in place for a reason.
Yes, in summary, at the end of the day, the lender or the lending group, they're responsible for that credit decision. They're the ones that's making the decision to say yes or no and how we structure that. So it's important for them. So we kind of get down here to the end of our discussion here today. I would say, let me give you a key takeaway. And this kind of goes into other things that I've talked about before, but cap rates, just think of cap rates before. They're not just a number. They can actually imply a signal of risk. So if you don't understand a cap rate, you may not understand the deal in general, the risk, the inherent risk that you're taking. So cap rates, as we mentioned, equals a risk signal. Joe?
Yeah, great way to wrap that up, David. And if you're working through a deal, something doesn't quite add up, whether it's the cap rate, maybe the tenant, or the valuation, that's exactly where we can help. At Lenders Online Training, we focus on helping lenders think through real world credit decisions. So you can visit our website to explore training programs, webinars, live streams like the one we're doing today, and our Ask the Experts platform, where you can bring real deals, real questions, and get feedback from me, David, or our founder, Linda Keith. Get feedback from us before you reach committee or before you get to that regulatory exam. So thanks for joining us today. Stay grounded, stay curious, and we'll see you next time at Lenders Online Training.